Welcome to readtheticker.com. I think you're going to find this interesting. It's about investing themes. Readtheticker.com's got a few famous names on the homepage. You can see them there: Wyckoff, Livermore, Ney, Hurst, Gann, Templeton, Lynch, O'Neill. What does this all mean? Some of these guys are technical timing, and other chaps are value investing, and other chaps are a mix of. So what's it got to do with readtheticker.com? Now, let me tell you a little story. Now, here's S&P 500 with a log chart, and here we have RTD trend status half month, which actually shows a good status of the trend, representing price. Now, Lynch is a value investor. Price starts falling. He says, that's below book value, or it's way down. Now's the time to consider looking at stocks to buy. You'll start buying stocks, probably with no debt, and you'll buy it at $20, and it may fall to $6 and go back up to $50. So he starts looking at value pretty quickly. So when the prices start to fall 20, 30%, he's starting to look around, starting to invest. Templeton's a value investor, but he's buying at maximum pessimism. He won't buy until someone's jumped out the window, or there's blood on the street, or someone's screaming Armageddon, or the Ice Age is coming, or dinosaurs are walking down Wall Street, something like that. He's maximum pessimist. He wants to buy stocks that were $25, $50 an hour back, below under $5. For example, Templeton would buy, I think his first investment of fame was buying £4,000 worth of $1 stocks during World War II. He bought 100 stocks under $1 during World War II, owned them for 5 years, so the war had ended and recovery had come back into it, and everyone realised, and he sold them for £40,000, which is a 4,000% return. He just bought them and held them, and out of 104 stocks, I believe, only 4 lost money. So if you can do that for 5 years, I think he did that continuously through his career. One of the very few billion-dollar investors out there, so very successful. So both Lynch and Templeton are value investors. It's just depending on how much pessimism you have to buy them. Now, the difference between Lynch, Templeton, and Wyckoff O'Neill is that the Wyckoff logic folks, they wait for evidence that the chart's recovering. For example, we have a falling price here, and then we have the rising price. They look for evidence that there's a change of behaviour, that price is starting to move up. Yes, they want a market falling. Yes, they want to buy at value. Yes, they are value investors, but they won't enter the market until after there's some evidence or proof that there's been a change of behaviour, that stuff is starting to go sideways and then rise. So once again, in the 2009 crisis, falling price would have sparked some concept of value for Lynch earlier on. You would have started looking at prices falling below book value and starting to say, yes, we'll have to look at the start accumulating here. But he would have got into early, of course, because nobody knows where the bottom is. Templeton, he wants to see where there's blood on the street. He wants to know screaming. He wants to know that the bond market's going to blow up. Then he starts buying. But O'Neill, Wyckoff, Ney, and Livermore, they realised that there was a bottom in place, but they didn't want to put their hard-earned money until after there was evidence that things were changing. So they lose the first. They don't, for example, no one times the bottom, but they lose the first 0 to 5% off the bottom until they know things have improved, and they start digging into the investing market once they see price advancing or a change of behaviour that's turning from a bear market to a bull market. So, yes, what I'm trying to say here, that the Wyckoff, O'Neill, the Livermore, Ney type approach, they are value investors. The only difference is they wait until price action has confirmed that the story is changing the stock and it's going to begin to rise. Whereas Lynch or Templeton, pretty much brought based on price relative to the value of the company. So they didn't really wait until price started turning around. Templeton could own a stock for 5 or 10 years before he got a decent return out of it. So it's a different attitude, different approach, different management skills. When you bring them together, it's the same sort of logic. It's all based on value. One requires a bit more evidence that things are turning around. That's why we have chosen those folks to lead the names of this website, because it's a mix of all concepts of value, change behaviour, Wyckoff, Livermore type logic to work out what's going on in the chart, whether it's the right time to invest. Thanks for watching.